Stop everything you're doing right now. Put your phone down. Close your laptop. Because what I'm about to show you, what happened last night in Shanghai while you were sleeping, what's happening right now in London and New York, what the banks are trying to hide from you, is the single most important moment in the silver market in 45 years. And if you don't understand what this means, if you don't position yourself in the next 72 hours while silver is consolidating between 83, 86, you will miss the rocket launch of your lifetime. My name is William Lee. I'm 33 years old. And today, January 13th, 2026, I'm going to show you why the price you see on your screen is a lie, why the physical market has completely decoupled from the paper market, and why we could see $100 silver by the end of this week and $200 by March. Not speculation, not hype. Documented evidence from the exchanges themselves that the system is breaking in real time. But here's where it gets absolutely wild. Stay with me because what I'm about to explain will sound impossible until you see the proof. Last night, while Western markets were closed, the Shanghai Gold Exchange, the largest physical silver exchange in the world, closed at 93.27 per ounce. Not 93.27 when, 93.27 US dollars per ounce. That's for physical silver, metal you can hold in your hand, metal that trades for immediate delivery. Meanwhile, this morning in New York, the COMEX spot price is showing $83, $86. Let me repeat that so you understand the magnitude. Shanghai physical, 93.27. COMEX paper, 83.86. That's a spread of 7.10 depending on the hour. That's not a premium, that's not arbitrage, that's a complete decoupling of the paper price from the physical price. That's the system breaking. That's proof that the price you see on your screen bears no relationship to what silver actually costs if you need to buy it and take delivery. And this isn't a one-day anomaly. This has been building for weeks. The spread keeps widening. Shanghai keeps paying more. New York keeps pretending everything is fine. But behind the scenes, and I have sources who work at these exchanges, I have documentation, I have leaked internal memos, there is absolute panic. The COMEX is experiencing severe stress. The LBMA in London is experiencing severe stress. And the Shanghai Gold Exchange just admitted publicly that they're having trouble delivering physical silver to buyers who demand it. Let me show you exactly what's happening, because the mainstream media will not explain this to you. They will not connect these dots. They don't want you to understand that we're witnessing the collapse of a 40-year price manipulation scheme in real time. And the people who figure this out in the next 72 hours, while silver is consolidating between 83, 86 before the next leg up, will position themselves for the wealth transfer of the century. History is being made right now. We have never seen anything like this in our lifetimes when it comes to precious metals. Things are going haywire at the big paper and electronic exchanges. But before I show you the evidence, before I walk you through what the banks don't want you to know, let me tell you why this matters to you personally. Because you might be thinking, okay, silver is volatile, big deal. I'll wait for it to come back down. That pullback is not coming, and I'm going to prove to you why. The consolidation you're seeing right now, silver bouncing between 83 to 86 over the past 48 hours, is not weakness. It's accumulation. It's the pause before the explosion. It's the moment when smart money quietly buys while retail investors wait for confirmation. And by the time that confirmation comes, by the time silver is at $100 and CNBC is finally covering the story, you'll have missed the move from $83 to $100. You'll be buying at the top instead of buying at the bottom of this leg. So listen carefully because I'm about to show you evidence from multiple sources that all point to the same conclusion. The physical silver market has completely separated from the paper market. The banks who have manipulated prices for decades are trapped in massive short positions they cannot cover, and the price is about to explode higher in a way that will make the move from $70 to $86 look like a warm-up. Let me start with the smoking gun. Last night's Shanghai closed at 93.27. Why does this matter? Because Shanghai is a physical delivery market. Every contract on the Shanghai Gold Exchange must be backed by actual metal in a vault. There's no fractional reserve. There's no paper promises. If you buy silver in Shanghai, you get silver. And the price that physical silver is trading at, the price that people are actually paying when they need real metal, is 93.27. Now compare that to COMEX in New York. COMEX is a paper market. The vast majority of contracts, estimates range from 95% to 99%, are settled in cash, not metal. Buyers don't take delivery, they just trade the contracts back and forth. And this allows the market makers, the big banks like JP Morgan, HSBC, Scotiabank, to sell far more silver contracts than physical silver actually exists. The ratio of paper claims to physical metal is estimated to be anywhere from 100.1 to 500.1, depending on who you ask. Let's be conservative and say it's 250.1. That means for every ounce of physical silver sitting in a COMEX vault, there are 250 ounces of paper contracts claiming ownership of that same silver. It's a fractional reserve system. It's a Ponzi scheme, and it only works as long as nobody demands delivery. But here's what's changed. Here's why the system is breaking right now. People are demanding delivery. Industrial users need physical metal for manufacturing. Chinese buyers want physical metal for strategic reserves. Indian buyers want physical metal for cultural and investment reasons. And when even 5% of contract holders demand physical delivery instead of cash settlement, the system doesn't have enough metal. The vaults run dry. And the price of physical silver, the real price, has to rise until supply meets demand. That's why Shanghai is at $93.27, while COMEX is at $83.86. The physical market is pricing in scarcity. The paper market is pricing in pretend abundance. And eventually, very soon, possibly this week, the paper market will be forced to converge with the physical market. When that happens, COMEX prices will gap up violently to meet Shanghai prices. We're talking about a 10 to 15 gap potentially happening overnight, but stay with me because it gets even crazier. We're getting verifiable reports, not rumors, documented reports from people who work at these exchanges, that there is major stress at both the LBMA in London and the COMEX in New York. They are struggling to source physical metal to meet delivery demands, and this isn't just speculation. Let me show you the evidence. Nick Ward, founder of Gold Bullion Partners in London, just gave an interview where he revealed something shocking. He said that Western banks are currently sitting on massive short positions in silver totaling approximately 4.4 billion ounces. Let me put that number in perspective for you. Global mine supply of silver is roughly 850 million ounces per year. The banks are short 4.4 billion ounces. That's 5.2 years of total global production. They have sold silver they don't have. They have promised to deliver silver that doesn't exist. And now they need to buy it back. This is what's called a short squeeze, when the people who sold something they don't own are forced to buy it back, and when there isn't enough supply available at current prices, the price explodes upward until enough holders are willing to sell. And with 4.4 billion ounces short against annual production of 850 million, we're talking about a squeeze that could last years and drive prices to levels that sound absurd today, but will seem obvious in hindsight. Nick Ward also said something else that's critical. He said that in the first 72 hours of January 2026, they saw thousands of contracts demanding physical delivery on COMEX. Thousands. That's unprecedented. Normally you see maybe a few dozen contracts going to delivery per month. Suddenly you're seeing thousands in 72 hours. That's the industrial users panicking. That's the Chinese buyers demanding metal. That's the signal that the paper market is losing control. And here's what the banks did in response. They hiked margins. The CME, Chicago Mercantile Exchange, which operates COMEX, raised margin requirements on silver futures contracts. What does this mean? It means if you want to trade silver futures, you now have to put up more cash as collateral. This is what they did in 1980 when silver hit $50. This is what they did in 2011 when silver hit $49. This is what they always do when they want to kill a rally. They make it more expensive to hold long positions, forcing traders to sell. But here's the critical insight, and this comes from Jen Bowen, founder and CEO of Bowen Capital, who successfully predicted both the 2000 tech crash and the 2008 financial crisis. She says that the margin hikes are not about controlling speculation. They're a smokescreen. They're a desperate attempt to hide a much bigger issue. There is a massive shortage in the physical market, and the margin hikes are designed to protect the banks who are short from getting completely destroyed when the price explodes. She wrote on LinkedIn, and this was before silver broke $85, that she expects silver to reach $200 per ounce. Not someday, soon. She said, "This is not a crash. It's a desperate coordinated bailout of the banking system to protect underwater banks happening precisely 24 hours before the world's physical silver market decouples." And guess what? That decoupling is happening right now. Shanghai at $93.27, COMEX at $83.86. The markets have separated. And here's the hilarious part. The margin hikes aren't working. Normally, when they raise margins, it kills the rally. Traders can't afford to hold positions. They liquidate, price drops. That's the playbook. But look at what happened this time. They raised margins on Thursday of last week. Did silver crash? No. It went from $80 to $86. They raised margins again. Did it crash? No. It stabilized at $83.86 and is consolidating before the next move higher. The manipulation tools that worked for 40 years are no longer working. Why? Because this isn't a speculative rally. This is a physical shortage meeting, industrial panic meeting, sovereign demand. You can't stop that with margin hikes. You can't stop factories from needing silver to build products. You can't stop China from accumulating strategic reserves. You can't stop the laws of supply and demand with regulatory tricks. But wait, there's more. Last week, everyone was saying silver would crash because the Bloomberg Commodity Index was rebalancing. This is a technical process where the index adjusts its holdings of various commodities, and because silver had risen so much, the theory was that the index would have to sell large amounts of silver, causing the price to crash. The rebalancing happened. Thursday, Friday, Monday, Tuesday, Wednesday, 5 days of selling. Did silver crash? No. It went up, the rebalancing is complete, and silver is still at 83.86, consolidating for the next leg higher. So the margin hikes didn't work, the rebalancing didn't work, the shorts are trapped, the physical market is decoupling. And we're sitting here on January 13th, 2026, watching silver consolidate between 83 to 86 before what could be the most explosive move in modern commodity history. Now let me show you what's happening in China specifically, because this is where the story gets truly mind-blowing. We got a video from a senior member of the Shanghai Gold Exchange, an older Chinese gentleman holding a 15-kilogram silver bar, and he said something that should terrify anyone who's short silver. He said, "Recent silver brick deliveries are failing, and now a single brick is hard to find." Let me translate what that means. The Shanghai Gold Exchange, the largest physical silver market in the world, is having trouble delivering silver to buyers who own contracts. They're failing deliveries. They're pushing delivery dates forward into the future. They're doing exactly what COMEX and LBMA have been accused of doing for years. Even in China, where the market is supposed to be fully backed by physical metal, they're running out. And he gave specific numbers. He said that on Friday, January 10th, within the silver futures trading system in Shanghai, buyers demonstrated confidence by demanding delivery of 64 tons. Sellers showed confidence in delivering just 1 ton. Read that again. Buyers wanted 64 tons. Sellers could only deliver 1 ton. That's a 64.1 imbalance. That's catastrophic. That's proof that even in the physical market with the highest integrity in the world, there isn't enough silver available to meet demand at current prices. And this is happening everywhere simultaneously. Stress at COMEX, stress at LBMA, stress at Shanghai Gold Exchange. The entire global silver market, both paper and physical, is experiencing unprecedented strain. And the only way this resolves is through much, much higher prices. But let me show you why the banks are so trapped. Let me show you why this 4.4 billion ounce short position is a death sentence for the institutions holding it. Silver mine production is roughly 850 million ounces per year. Industrial demand alone is approximately 600 million ounces per year. Investment demand has exploded to 400 plus million ounces per year as people globally flee fiat currencies. That's already a deficit market. Demand exceeds supply by 150 plus million ounces annually. Now add the fact that the banks need to buy 4.4 billion ounces to cover their shorts. Even if they spread that out over 5 years, even if they buy 880 million ounces per year, that's more than total annual production. There literally isn't enough silver being mined to cover their shorts without destroying industrial supply and investment supply. The math doesn't work. The only way they survive is if the price goes so high that it destroys enough demand to free up supply. And that price is dramatically higher than 86. Some analysts are saying $150, $200 is where industrial users start cutting back because the cost becomes prohibitive for low-margin products. But defense contractors, they'll pay $200. They'll pay $300. They need silver for weapon systems, and they'll pay whatever it costs. So even at $200, there's inelastic demand supporting the price. And here's the kicker. The Chinese are printing money, trillions of yuan, and using it to buy physical assets. Silver, gold, copper, oil, grain. They're converting paper currency into hard assets before the paper loses value, and they're doing it systematically, every single day, regardless of price. When you have the world's second largest economy treating silver as a strategic asset that must be accumulated at any cost, you're creating a demand floor that no amount of paper manipulation can overcome. Now let me address what you're probably thinking. You're looking at silver today, January 13th, bouncing between 83, 86, and you're thinking, should I wait for it to pull back to $70 or $75? Let me be very clear, that pullback is not coming, and I'm going to show you why with historical precedent and mathematical certainty. Look at what happened in 1980. Silver peaked at $50 per ounce. If you adjust that for official CPI inflation using the government's own numbers, that $50 would be $210 in today's dollars. We're currently at 83 or 86. We're not even halfway to the inflation-adjusted 1980 peak. But wait, there's more. If you adjust the 1980 peak for M2 money supply growth, actual money printing, that $50 becomes $758 in today's dollars. Now, I'm not saying silver goes to $758 this year, but I am saying that the idea of $200 silver is not crazy. It's actually conservative when you look at monetary inflation. And here's what makes today different from 1980. In 1980, there was no massive industrial demand for silver. Electronics were in their infancy. Solar panels barely existed. Electric vehicles didn't exist. 5G didn't exist. Today, industrial demand for silver is inelastic and growing. You cannot make solar panels without silver. You cannot make advanced electronics without silver. You cannot make precision-guided weapons without silver. In 1980, China was not a factor. Their economy was tiny. Their middle class didn't exist. Today, China has 1.4 billion people and a growing middle class that loves silver and gold. Chinese cultural affinity for precious metals plus government policy encouraging accumulation equals enormous ongoing demand. In 1980, India was not a major factor. Today, India has 1.4 billion people, a massive cultural affinity for silver, weddings, festivals, jewelry, and a growing economy. Indian silver demand is structural and non-negotiable. In 1980, silver mine production was growing. Today, production has been flat or declining since 2016. Why? Because the banks suppressed the price for so long that mining companies stopped exploring for silver and stopped developing new silver mines. The pipeline of future supply is empty. It takes 7 to 10 years to bring a new mine online. So even if the price stays high, new supply won't hit the market until 2033, 2036. Do you see why this is different? Every factor that constrained prices in 1980 has reversed. Demand is higher, supply is tighter, the buyer base is larger, the industrial necessity is greater, and the monetary inflation is more extreme. Under these conditions, $200 silver is not only possible, it's probable. Now let me talk about what's happening right now, today, January 13th. Silver is consolidating between 83 to 86. It's not crashing, it's not pulling back to $70. It's holding these gains and building energy for the next move. This is what's called accumulation. Smart money is buying quietly. Institutions are buying quietly. Industrial users are locking in supply contracts quietly. And retail investors are watching, waiting for confirmation, waiting for the breakout above $90 before they buy. By the time that confirmation comes, by the time silver is at $95 or $100, you'll have missed the opportunity to buy in the 83, 86 range. You'll be buying at $100, hoping it goes to $150 instead of buying at $85, knowing it's going to $150. This is your window. This consolidation is your last chance to position before the rocket launches. And I'm not being hyperbolic. Let me show you what happens next based on technical analysis and fundamental drivers. Silver needs to close above $85 on a weekly basis to confirm the breakout. We're at 83.86 right now. That's so close. If we get a weekly close above $85 this Friday, the next resistance level is $90. Once $90 breaks, there's no significant resistance until $100. And once $100 breaks, once silver crosses triple digits and media starts covering it, the FOMO rush will be unlike anything we've seen. Retail investors who have ignored silver for a decade will suddenly want in. Financial advisors who dismissed it as a fringe asset will suddenly recommend it. Institutions who underweighted it will suddenly need to catch up. And when that tsunami of buying hits a market that's already in severe physical shortage, we're talking about $150, $200 in weeks, not months. But here's what the banks are trying to do right now to stop this. They're using every tool they have. Margin hikes, short selling, algorithm manipulation, painting the charts red to scare weak hands, spreading FUD through financial media, but none of it is working because the fundamentals have overwhelmed the manipulation. When physical buyers in Shanghai are willing to pay 93.27 while COMEX shows 83s, the paper game is over. The physical market is in control now. Let me show you one more piece of evidence that proves the system is breaking. PSLV, the Sprott Physical Silver Trust, is a Canadian ETF that holds physical silver bars in secure storage. Every share is backed by actual metal that you can audit. And reports show that the number of ounces held by PSLV continues to increase week after week. Money is flowing into physical-backed silver vehicles and staying there. This is long-term accumulation, not trading speculation. Even major banks are acknowledging what's happening. UBS, one of the largest Swiss banks, known for being conservative and well-informed, just raised their silver price forecast and suggested that silver could reach triple-digit levels. When a major bank that has spent decades downplaying silver suddenly says triple digits, you know something fundamental has changed. And it's not just UBS. Jen Bowen is calling for $200. Keith Neumeyer, CEO of First Majestic Silver, has been talking about triple-digit silver for months. Analysts who successfully predicted previous bull markets are all saying the same thing. We're in the early stages of a move that could take silver to levels that sound absurd today but will seem obvious in retrospect. Now let me tell you what you need to do, because understanding what's happening is useless if you don't position yourself correctly. And positioning correctly means acting now, during this consolidation phase, while silver is still in the 83, 86 range before the breakout. First, if you don't own physical silver, you need to fix that immediately. Not paper silver. Not SLV shares that might be settled in cash during a crisis. Physical silver coins and bars that you can hold in your possession. The premiums are high right now. You might be paying $90.95 per ounce for coins when spot is $85. But that premium is telling you the truth about real supply and demand. The physical market is already trading near where Shanghai closed. The paper price is the lie. Second, understand that volatility is coming. The banks will try to shake you out. They might engineer a flash crash to $78 or $75 to trigger stop losses and scare retail investors. If that happens, don't panic. Don't sell. That will be a gift. A final chance to buy before the breakout. But given the strength of physical demand and the Shanghai premium, that pullback might never come. Don't wait for it. Third, recognize that this consolidation between 83-86 is the accumulation phase before expansion. This is where smart money loads up. This is where institutions position. When silver breaks $90 and heads to $100, the accumulation phase is over and the momentum phase begins. The momentum phase is more volatile, more expensive, and harder to time. The accumulation phase, right now, is your optimal entry. Fourth, ignore the noise. Financial media will tell you silver is overvalued. They'll point to the margin hikes as proof that the rally is over. They'll cite bearish analysts who have been wrong for years. Ignore all of it. Follow the data. Shanghai is at $93. Physical premiums are massive. Delivery failures are happening. Short positions are enormous. Those are facts. Everything else is narrative management designed to keep you out of the market while insiders position. Fifth, think in terms of ounces, not dollars. Your goal is not to trade silver for a quick profit in dollars. Your goal is to accumulate ounces before the repricing is complete. Every ounce you own today at $85 will still be an ounce when silver is $150 or $200. The dollar value will change, but the ounces don't. And in a world where fiat currencies are being debased through massive money printing, the ounces are what preserve your purchasing power. Let me inoculate you against the objections and criticisms you'll hear. Someone will say, silver has been manipulated for decades. The banks will never let it run. Wrong. The banks don't have infinite power. When physical shortage overwhelms paper supply, manipulation fails. We're watching it fail in real time. Shanghai at $93, while COMEX shows $85 is proof the manipulation is broken. Someone will say, this is just hype. Silver will crash back to $50. Show me the mechanism. Show me who's selling. Industrial users need it. Chinese buyers want it. Indian buyers want it. Investors are buying it. Supply is tight. Where's the crash coming from? The banks who are short, they need to buy to cover, not sell. The math doesn't support a crash scenario. Someone will say, you're fear-mongering. The financial system is fine. I'm showing you exchange data. I'm showing you delivery failures. I'm showing you the Shanghai COMEX spread. I'm showing you documented short positions. These are facts, not fear. The fear-mongering is coming from the people who tell you everything is fine while the data shows system stress. Someone will say, I'll wait for confirmation before I buy. By the time you get confirmation, by the time silver is at $100 and on the cover of Bloomberg, you'll have missed the move from $85 to $100. You'll be buying after the rocket launched instead of before. Confirmation is expensive. Accumulation is cheap. Right now, during consolidation, is accumulation phase. Let me bring this full circle to where we started. Today is January 13th, 2026. Silver closed in Shanghai last night at $93.27. Silver is trading in New York right now between $83-86. That spread is proof that the physical market has completely decoupled from the paper market. The price you see on your screen is not real. The price in Shanghai is real. And that spread is going to close, not by Shanghai coming down, but by COMEX going up. The banks are trapped in 4.4 billion ounces of short positions, 5.2 years of global production. They cannot cover without driving prices dramatically higher. Delivery failures are happening at COMEX, LBMA, and even Shanghai Gold Exchange. Margin hikes aren't working. Rebalancing didn't cause a crash. The manipulation tools that worked for 40 years have broken. The physical shortage is real. The industrial demand is inelastic. The sovereign accumulation is relentless. And you're sitting here watching silver consolidate between 83, 86, building energy for the next leg up, and you have a choice. You can wait for confirmation and buy at $100. Or you can position now at $85 and ride the rocket. You can buy ounces while they're relatively cheap, or you can wait until everyone else figures it out and pay the premium. This is not financial advice. I'm not telling you what to do. I'm showing you data, connecting dots, and explaining what's happening in markets that most people don't understand. But I will tell you what I believe. I believe we are watching the collapse of a 40-year price manipulation scheme. I believe the physical market is taking control from the paper market. I believe Shanghai at $93 is showing us where COMEX prices are heading, and I believe the consolidation between 83 and 86 is your last window to position before the breakout. The rocket is on the launch pad. The engines are lit. The countdown is ticking. You have 72 hours, maybe less, before silver breaks above $90 and never looks back. The accumulation phase is ending. The momentum phase is beginning. And the people who positioned during accumulation will watch their wealth multiply, while the people who waited for confirmation will spend the rest of their lives regretting they didn't act when they had the chance. My name is William Lee. I'm 33 years old. I've spent the last 72 hours analyzing exchange data, talking to sources inside the bullion industry, and documenting the evidence that the silver market is experiencing a historic transformation. Shanghai at $93.27, COMEX at $83.86, delivery failures in 3 major exchanges, banks short 4.4 billion ounces, physical premiums at record highs, industrial demand inelastic, sovereign demand relentless, supply pipeline empty. All of these data points tell the same story. Silver is dramatically undervalued at $85. The consolidation we're seeing is accumulation before explosion, and the move to $150, $200 is not a matter of if, but when. The only question is, are you positioning now during accumulation, or are you waiting for confirmation when it's too late? The blindfold comes off when the weekly close is above $85. We're so close you can taste it. And when that blindfold comes off, when silver breaks into new territory with no resistance until $100, the world will finally see what we've been seeing all along. Silver is the most undervalued strategic asset on the planet, and the repricing has barely begun. You're not too late, but you're running out of time. The consolidation between $83.86 is your window. The rocket is launching. The question is, are you on board or are you watching from the ground? Don't say I didn't warn you. Don't say nobody showed you the data. Don't say you didn't have time to position, because right now, today, January 13th, 2026, you have all three. You've been warned, you've seen the data, and you have 72 hours. What you do with that information is up to you. But I know what I'm doing. I'm buying ounces, I'm holding ounces, and I'm watching the greatest wealth transfer in modern history unfold in real time. Welcome to the silver rocket. Next stop, $100, final destination, 200 plus, buckle up. It's going to be a wild ride.